Okay, so let's jump right in. If you just look at the surface, the public markets seem pretty calm. Equities are rallying, there's all this excitement around AI, but if you look just beneath that calm surface, a totally different story is starting to unfold. So that's what we're going to dig into today, why some of the smartest investors are shifting their focus away from just pure growth to something a little more durable, resilience.
And this quote from Nils over at Schroders Capital? It just hits the nail on the head. It perfectly captures the tension we're talking about. This really sets the stage for our whole conversation today, that critical difference between how things look and the reality that's actually taking shape. So what exactly are these dark clouds he's talking about?
And this is where it gets really interesting. You've got this huge contrast between the headlines and what's bubbling underneath. The market's cheering on rallying stocks and AI euphoria, but behind the scenes, serious investors are focused on the stuff that's actually keeping people up at night. Inflation that just won't go away, geopolitical hotspots flaring up, and a ton of uncertainty around trade. It's exactly this disconnect that's forcing a whole new way of thinking.
So here's our game plan. We'll start by looking at those storm clouds. Then we'll build the case for why resilience is the name of the game now. After that, we'll get into the specifics, opportunities in private equity and in real assets. And finally, we'll tie it all together with a new investment playbook for this kind of environment.
All right, let's kick things off with Section 1, Storm Clouds over Markets. We're going to talk about those hidden risks in what, from a distance, looks like a pretty calm environment.
Look, the AI excitement is incredible, right? But if you look at history, major tech breakthroughs are almost always followed by these big boom and bust cycles. And you have to add that to the mix with central banks being so unpredictable, serious questions about government debt levels, and of course the ongoing conflicts in Ukraine and the Middle East. You can start to see why some investors are getting a little nervous and looking for some shelter.
So that's the problem, which naturally brings us to our second section, the case for resilience and how private markets might just offer that alternative path investors are looking for.
Okay, so there's this key idea called cyclical decoupling. It sounds super technical, I know, but trust me, the concept is pretty simple. It's all about finding investments that don't just ride the same exact roller coaster as the stock market. They've got their own thing going on, their own drivers, which can give your portfolio a nice cushion when the public markets get all choppy.
So why are private markets such a good place to find this? Well, for a few huge reasons. First, they give you exposure to tangible, real-world assets. I'm talking infrastructure, buildings, things you can actually see and touch. Historically, they've done better when public markets are going haywire. And they let you tap into these massive long-term trends, what we call structural tailwinds, like the global energy transition. At the end of the day, it's all about finding different sources of return.
So let's dive into our first major area of opportunity here in Section 3, private equity. This is all about backing real transformation and innovation.
The big theme in private equity right now can be summed up in just 3 words. Small is beautiful. Seriously, the real action isn't in those massive, splashy, headline-grabbing deals. Nope, it's way down in the smaller end of the market. And this chart, man, it shows you exactly why. The valuation gap is just huge. On average, small and mid-market buyouts are trading for about 7.7 times earnings. That's over 40% cheaper than the big guys. That creates an incredible margin of safety and a whole lot more room to actually create value.
So, how are investors actually playing this? Well, it pretty much boils down to 3 main strategies. First, they're backing local champions. These are businesses focused on their home turf, which insulates them from all the global trade drama. Second, they're finding companies where they can get hands-on and drive transformational growth through operational fixes. And third, they're embracing what's called multipolar innovation, which is just a fancy way of saying they realize game-changing tech isn't just coming from Silicon Valley anymore. It's coming from hubs all over the world.
Another tool that's getting super popular is the continuation vehicle. Think of it like this. A private equity manager has an absolute star company in their portfolio, but the fund's 10-year clock is about to run out. Instead of being forced to sell their winner, they can create a brand new fund just to buy that company from the old fund. It lets them keep growing it and gives them a much longer runway to create value. Now for our fourth section. Let's switch gears a little bit. From investing in companies to investing in the physical world. Let's talk about opportunities in real assets.
After taking a beating for a couple of years with interest rates going haywire, real estate has had to, reset its prices. It's gone through a pretty significant adjustment, and what that correction has done is create what a lot of people are now calling a buyer's market.
And the real story here is in the split.
I mean, look at office properties. They took a nosedive, and the recovery is pretty small. But industrial and logistics spaces, a completely different story. Shallow dip, strong recovery. The big takeaway here is that overall pricing really seems to have hit a bottom, which suggests we're at an inflection point. And that means it's a pretty attractive time to put capital to work.
The other huge story in real assets is infrastructure. And in that world, there is one theme that is just dominating everything else: the energy transition. And when I say it's huge, I mean the scale is just mind-boggling. In Europe alone, the market for renewable and energy transition infrastructure is on track to more than double, hitting 1.3 times trillion euros by the early 2030s. This isn't some small niche play anymore. It's becoming the dominant force in the entire sector.
And of course, we can't forget private debt. It's kind of like the grease that keeps the wheels turning for a lot of these real asset projects. It provides these resilient, steady income streams, and it's often secured by the very infrastructure projects in real estate we've been talking about.
Okay, so let's pull all these threads together in our final section, the new investment playbook. We're going to summarize the 5 key features of a portfolio that's built to be truly resilient.
So what does this new playbook actually look like? Well, first off, it means looking for areas where capital isn't overcrowded, because that's where you'll get better entry prices. It also means favoring those domestic businesses to sidestep some of the global volatility. A resilient portfolio finds unique ways to make money, protects its downside with real assets, and maybe most importantly, finds investments that don't just move in lockstep with the public markets.
And all of this leaves us with one final big thought. For years, the investment world has been completely obsessed with growth at all costs. But as the landscape keeps shifting and those dark clouds keep gathering, you have to ask, in this new, more volatile world, is resilience about to become the new growth? Definitely something to think about.